afternoon, everybody, and welcome to the latest Service Department News webinar. Today, we are going to be talking about the investment and finance landscape in the sector. My name is George Sell. I'm editor of Service Department News, and we are a B2B platform for the Service Department, apart hotel, and extended stay sectors. Now, the Service Department News webinar stream has a couple of sponsors, and we are going to find out a bit more about them before we kick off the discussion. The first of our sponsors is IMS. Okay, thank you very much to IMS for sponsoring, and if you'd like to get in touch with them, you can see the details in the chat. Our second sponsor is Corporate Housing Factory.
We are Corporate Housing Factory, your go-to company for booking temporary and extended stays in the Netherlands. Let me tell you what we do. We have about 200 service departments in the Netherlands in all major cities. Big, small, luxurious, minimalistic, modern and cosy. Our apartments are always fully furnished, weekly cleaned, provided with super speed internet, and we can offer an airport pick-up or drop-off too. Now, tell us what type of apartment you're looking for.
Okay, thanks to Corporate Housing Factory, and again, if you'd like to get in touch with them, you can see their details in the chat. So today's webinar is an hour long. We're going to have around 45 to 50 minutes of panel discussion with some Q&A at the end. So if you have any questions, please do submit them using the Q&A or the chat function in Zoom. A recording of the session will be sent to everyone who is registered via email in the next couple of days. Just wanted to show a few screen grabs from stories that we've run on Service Department News over the last few months, just to illustrate some of the things that are going on in the sector that we'll probably touch upon in the conversation today. You can see some various types of funding stories here. So the Apartment Network, which is an agency receiving funding to grow. Bob W, which is a kind of hybrid service department vacation rental company, has just secured a chunk of investment in a Series A round. Stay City has taken on new finance with Oak North and opened its largest property in Europe. And on the next slide, some quite interesting stuff here that we're going to move on to. Eden acquiring properties, hotel properties for conversion to an apart hotel service department model. Ascot, which has been a company that has owned its fair share of inventory, is now strongly pushing an asset-light strategy. And its parent company, Capitaland, is also getting involved with the green finance movement with a sustainability-linked bond. So we've got a great panel to discuss all this and more with today, and I'm going to ask them to introduce themselves one by one. We'll go from left to right, and we'll start with you, please, Louise. Welcome to the session this afternoon.
Hi, thanks for having me. My name is Louise Gillon. I'm the head of hotel finance at Leumi UK. We're active lenders on hotel assets, acquisitions, refinancing, repositioning, renovating and new build developments throughout the major cities in Western Europe.
Excellent. Thank you, Louise. And Andrew, good afternoon to you.
And good afternoon to you and to everyone. Thanks a lot for inviting me. My business is AHB Associates, been around 21 years. We do investment banking boutique, we do mergers and acquisitions and capital raising and across Europe. And for the last 10 years or so, we've pretty much exclusively focused on hospitality. And pleasure to be here.
Thanks, Andrew. And finally, William, welcome to you.
Good afternoon, and thank you very much for the invitation. So glad to be here today. So my name is Kirkpatrick. I'm head of hotels and extended stay at Gerald. So we're real estate advisors and valuers. We're the UK's largest hotel property asset managers, UK's largest property taxation specialist, and then we're Europe's largest hotel independent advisory team.
Excellent. And Will, when did your job title change to include extended stay in the title?
Probably about 2-3 years ago. We were valuers, apologies to Louise, cover years for HSBC when they funded SECO. So we actually started off in the sector quite early off. So probably about 10-11 years ago, we started valuing the SECO portfolio, and from that there we've went on to advise areas on the native portfolio, and then we've often advised numerous landlords on stay cities and so on. So it was really clear to us that this is part of the market that was going to grow and had some legs to it, as they say. So yeah, so it's probably 2 years ago.
Yeah, excellent. Thanks, Will. You can see the LinkedIn profiles for all our speakers today in the chat. So if you want to carry on the conversation with them afterwards, then please do so. So let's start by evaluating investor sentiment to the sector. It obviously improved strongly over the pandemic as extended stay properties were able to stay open and trading. But we've obviously got a different set of issues and challenges around now. It was interesting this week at the Deloitte conference, their survey of a whole bunch of investors with billions and billions under management. They were asked to rank the most attractive asset classes, and service departments was second behind hotels and ahead of PBSA. Andrew, how would you assess that, and how would you assess investor sentiment to the sector broadly? Is it as high as it was immediately after the pandemic?
Well, I think as ever in my business, the answer to the question is yes and no, right? So there's a substantial amount of money in funds, in closed-end funds. There's a lot of money in the banking system, in debt funds. The capital adequacy or the capital ratios of the banks looks good. I mean, there's a lot of liquidity in the market, right? Full stop, which makes it very different from, excuse me, from 10 plus years ago after the global financial crisis. In the last few months, we've had a period of instability. And whenever there is instability, it doesn't matter how attractive a particular sector is or not attractive, you get very few people who are willing to commit. That's just the reality of it. Now, my view on this stuff is actually quite simple, which is that there is no better real estate asset that is inflation resilient, or that is protected in as much as possible, as much as it is possible to be, than the hospitality sector. And obviously some, luxury hotels, you can easily pass through costs, probably bottom end of the market, extended stay, you've got limited service, you've got limited members of staff, numbers of members of staff, usually energy is a small cost. So there's subsectors within the hospitality industry that are better than others, but overall, it is an inflation resilient sector, right? So as soon as there is some stability in the capital markets, and we have started to see that, actually, we follow quite religiously the 5-year and 10-year gilts market, and the returns available 5-year, 10-year gilts market are now below the level they were before the mini budget, right? So I would expect to see, and I'm seeing in our own business, more and more people engage in terms of looking at acquisitions or looking at financings, and that will translate into more and more transactions over the course of the next 3 to 6 months. So the answer to your question is the sector is very attractive. Lots of funders know it's attractive. We've started to get stability. I would expect that stability to continue. There are transactions being discussed right now. We know that from our own business. I would expect first quarter next year, those transactions to start happening, and hence everybody will say the market's back.
Thank you, Andrew. Will, we mentioned that you guys at Gerald Eve were early adopters, if you want to use that phrase, and enthusiasts for this sector. Does what Andrew said tally with what you're seeing? Do you think this is still a particularly attractive area of hospitality?
I don't like agreeing with Andrew, I always like to disagree with him, but unfortunately in this case I have to agree with him. I think it's probably actually, Andrew, I think on this here, possibly I might be a bit more positive than you, which is quite unusual, so for a valuer to be positive. But where we're saying, if you speak to any of the pension funds and institutional investors, so there's two parts to this, isn't there? There is traditional funding and institutional investors, also there's many more than that, but that's the two key sectors. But the institutional investors see extended stay as one of their growth areas. I mean, if you speak to most of the pension funds and you say to them, where do you want to invest? If build costs and gilts and so on were at normal levels, then they would be definitely saying, the extended stay and service departments of aparthotel, it's certainly where they want to be. So no question about that. That's very much on the radars. In terms of, traditional, I'll let Louise speak in terms of traditional banking. But again, the sectors, people are now starting to see just how strong the sector is. And there's very, very few businesses at the end of the day that throw out that level of profit conversion. So I cut my teeth. I still work with Whitbread, of course. But the budget hotel model is quite similar in terms of the high profit conversion from select service product. And then if you've got the extended stay element on top of that, it is one of the most robust businesses in the hospitality sector that you can invest into. And from that viewpoint, I think, I don't know any investor yet at the minute who doesn't see this sector as one of the leading sectors.
Yeah, thanks, Will. Andrew, over the last few years, we've seen some notable examples of this sector bucking a broader trend in hospitality, which is having the OpCo and the PropCo under the same ownership. So we've seen Brookfield, APG and Fortress, to name but three, acquiring extended stay assets and operating platforms. But then we saw this announcement from Ascot last week saying that they are going to focus mainly on being an asset-light business from now on in their growth plans. Do you think that this OpCo PropCo thing was a bit of a blip and a sort of product of its time, or do you think we'll continue to see more of those deals?
No, look, Ascot, I have to tell you, is a bit of a special case. Ascot have hardly bought anything in the last few years, despite being shown everything. Right, so Ascot just have a big problem, which is actually taking decisions on buying real estate. It's a lot easier to take decisions on asset light, on buying other operators or doing management contracts or whatever. This has been in the works for some time, and I don't think that you can take that as being indicative of the market generally. Ascot is a very unusual company with very unusual owners, essentially the government of Singapore. So I absolutely think OpCo, PropCo, there's a real premium on, or there will be a lot of interest in PropCo and OpCo combining. There's also, the same time as OpCo and PropCo are being combined, or the acquisitions of both together are taking place, you're also seeing in other parts of the market them separating, right? Which is quite interesting. And the reason why that is because there's real synergies to be extracted the bigger the OpCo is, right? So if you've got a big OpCo and you just focus on that, then you can approach real estate owners with a better proposition. So there's sort of industry dynamics which are promoting the different models. But if your question relates to OpCo and PropCo being combined, like Brookfield, et cetera, I've absolutely no doubt whatsoever that model will absolutely continue.
Yeah. Okay. Will, you're nodding your head. You're agreeing with him again.
Yeah, I'll just go shortly. I think if you look at the major, the major UK aparthotel operators, most of them are looking at leases. I mean, if you look at Marriott Residence Inn and look how many sites they've got in the UK and so on, the lease structure has enabled people like Stay City to grow that model very quickly. And I think, if that was done via a franchise route, they wouldn't have got to where they are today. That's quite a big statement. But, the only issue at the minute, and it's quite depressing at the minute, is if you look at forward funding in terms of development and so on. So if you speak to an acquisition surveyor at the minute, your build costs, I'm now going to speak as a valuer, your build costs are just far too high. The debt's too expensive. Sorry, Louise. And, there's so much uncertainty in terms of contractors. And it is very, very difficult at the minute. It is really, if you're an acquisition surveyor at the minute, the chances of actually getting something to stack up at the minute are very, very rare. So therefore, I do understand why some people are now looking at franchise agreements and management agreements, because somebody else you can take it, an existing product and so on. So I think, it is horses for courses, but I certainly believe that the lease model works very well if the rents are set at the right level. But I mean, just the build costs and movements of yield and so on, it's quite crippling at the minute.
George, can I just say one other thing?
Of course.
I'm going to actually disagree with Will.
Good.
We've agreed for 15 minutes. Big bold statement coming. I actually think the lease model is going to become much less important in the future. And the reason why is it's very, very difficult to get any form of real inflation linking on leases because they're always capped, right? I think in an inflationary world, there'll be real attraction to own profits. P&L.
But you said that, but for pension funds, pension funds can buy, before the gilts problem happened, for them to go out and get 25 years of index-linked income, and better than I do, what they'd have to pay to get that. So the pension funds can pay quite keen yields for very clean, vanilla, high quality assets based on CPI 0 and 4, or if you can get RPI or CPIH and so on. So that they are for them, the pension funds, this works very, very well for them. And then for the operators, Andrew, you're absolutely right in that for the operators, this is great because actually their business will grow more than CPI. So therefore, as the lease continues, they should be able to, that rent cover then should improve.
Yeah, but Will, you don't get full inflation linking with leases because they're all capped. They're all capped at 4% or 5%. It leave you in a high inflationary world. Yeah. Work for pensions, and the reason why pension funds buy leases is largely regulatory, right? Regulatory, and I think we're moving towards an American type market structure where the vast majority of operators are on management contracts.
Well, I mean, so certain, as you know, we advised L&G on their first London hotel management agreements. You're absolutely right, Andrew. There is going to be more of it. I don't think the lease structure is going to fall away. I think it will be for prime assets. Then pension funds should be doing management agreements rather than leases. But the issue is there's so much money to go out there and to be spent by the pension companies and so on that they can't all do management agreements in prime areas. They will have to invest in secondary locations, and secondary locations, getting an index linked lease does work and also enables a lot of these. I mean, if you look at the growth in terms of operators, by taking leases, they've been able to faster expand than some of those who've been doing franchises.
How refreshing to have a little bit of friction on a webinar. It doesn't happen very often.
Will and I rarely agree. Anyway.
Exactly. So, but Louise understands in terms of the debt piece. I mean, in terms of development debt.
Yeah.
Challenges.
Let's come to Louise and talk a bit about the lending side of things. Louise, when we launched Service Department News in 2013, I think, this sector was looked at as very niche, and it was quite hard for developers and operators to secure lending, whether that was development finance, whether it's to grow their businesses. And I remember a lot of people at the time saying lenders were a little bit overly obsessed with a recognizable brand name. They were uncomfortable with a slightly new concept. And it was a bit of a slow burner for a while. Obviously, it's not niche anymore. Do you want to just talk us through how attitudes of lenders towards this sector have changed in that time?
Yes, I think with everything, lenders like to have something, a historical track record that you can look back on and have some level of comfort. So whenever there's something new, then there is a resistance, because obviously we have to be the conservative ones. Also, I think the sector, there wasn't perhaps the availability of data in the market. If you look at hotels, then obviously we're seeing, especially throughout the pandemic, you're seeing weekly webinars on the status, how things are finding things, what cities are achieving what rates, and you can get comfortable that you've got something similar to look at, to take a comparison from. That's becoming more available in the service department sector, but it's certainly not as regular as you would see in the hotel. So I think the level of transparency of data is perhaps a small concern. However, I think we can all buy into the product offering. I think it helps that now we've all stayed at one. We all understand the benefits of the product offering. We all understand that actually, you know, if I was going to go and stay somewhere for 14 days, do I want it to be in a budget hotel or even a very nice hotel? Or do I want to have my own space? Yes, I could buy into that. So I think there's the personal element. Every banker is still a person. You can put your own feelings into it, and it makes sense. I think also, at the moment, with the cost pressures that are in place on staffing and so on, then actually this sector is more isolated from that. They're operating, you know, with far fewer staff than, you know, a 4-star hotel would, but achieving the same sort of product delivery. So I think that you can see the data's there to support that there's higher margins attributable to this asset class. They're successfully achieving very good occupancy rates, so there's definitely the demand in the market. And actually, if anything, I think that the sector is suffering from an undersupply and perhaps a lack of transactions that have happened to support the values that have been attributed to the asset. But our appetite is strong for the sector. I have to say that I'm not approached regularly to finance this sort of asset. So I think that is symptomatic of the fact that it's a very small piece of the, you know, the hospitality market at the moment. Potentially I should do what Will's done and just add something additional to my title so people know that I'm interested in the asset class. But I think there is the appetite to lend on these assets now, certainly.
Yeah, well, hopefully appearing on this website will be the first step in people being aware that you've got an appetite to lend. Do you think the pandemic was the kind of catalyst to a lot of lenders becoming more comfortable with the sector, the way it outperformed every other hospitality asset class?
I don't think so, actually. I think that we made a lot of everybody's desire to social distance, and therefore, you know, this asset class would be the chosen one. But actually, I don't think that was the case. I think that we were already in a position where corporates had more freedom to choose where they wished to stay, and you were already attracting a broader corporate market to the asset. So I think it helps that there has been more industry commentary on this specific element of the industry. But I think actually the appetite was already strong.
Yeah, okay, thanks, Louise. Will, one of the things I'm quite interested in is conversions from hotels or other asset classes to extended stay. One of the slides I showed earlier, you know, the last 2 acquisitions Eden have made for Lock have been existing hotels that they're going to convert. Is that something you think we're going to see more of next year?
For sure, because at the minute, if we can't do any development, because obviously funding for just doesn't work in terms of build costs and so on, then, you know, people like Eden are now looking at, as you say, existing hotels. So what they're looking at, just to contextualize this, is 4-star hotels, which are run down in poor condition. And because they're 4-star hotels, actually, the room sizes can lend themselves to being converted into an apart hotel. So it's quite specific what they're looking for and what they can develop through. I mean, if you look historically, there's very, very few. If you look at the existing supply pipeline, there's very few hotels that have been converted into service departments or apart hotels. And obviously part of the reason for that is it wasn't economic then to do so. So we will see more for sure, but I still think it's quite limited, and some of the brands are still quite keen to be hard brands in terms of their delivery of products. But the office buildings converting is much easier in some ways.
Yeah. I think another fairly recent phenomenon as well, there's a very strong presumption in planning departments now to reuse rather than opt for new builds, which I think will probably contribute to even more conversions.
Well, if you look at Westminster, for example, and the Marks and Spencer's case that's going on at the minute is a classic example. So, there is, and rightly so. I mean, there is, to take down a building and then to rebuild it again. The amount of carbon that is, the impact is quite material. So actually repurposing existing is good. And if you look at Stay City on the Strand, the Wild product, that's an office building that was converted, and that's worked very well for them.
Yeah. Louise, in terms of the lenders' attitudes to reuse versus new build, presumably that's flip-flopping all the time as factors around it change. I mean, obviously materials prices have gone up. Construction workers are in short supply. So what's the kind of prevailing view at the moment?
So we historically have always kept our book quite well balanced between trading assets and development projects, and certainly throughout COVID that was a great plan, because the trading assets needed a lot of help and support, and the development projects kind of looked after themselves. Now it's definitely flipped the other way, and it's very hard to analyse a development project and not break it with your analysis. If development projects are always delayed or cost overruns, it's just symptomatic of them. So as soon as you start factoring in just reasonable delays to the project and the impact on costs that has, it really makes it difficult to make a development project particularly viable at the moment. Which obviously leads me to say that the fit out, the renovation of an existing building is the way to go. However, in my experience, sometimes renovations of existing buildings can end up even more costly, because by the time you've stripped out an existing building and you found something that you don't like, it's not a cost that you were accommodating in your original plan. So I think either way you look at it, it is going to be difficult to bring new supply to the market in the next couple of years until we have some more certainty around build costs. And as you say, hopefully we're hoping for some more stability in Q1. But I think there will be a period in time in which it is difficult to get development funding for that purpose. I mean, there's a way of funding everything, starting from the right debt level. You can fund anything, but the right debt level potentially won't be interesting to investors at the current time.
Yeah, okay, thanks, Louise. Just a quick reminder, if you do have any questions for our panelists, please do submit them in the chat or the Q&A, and we will get around to answering them towards the end of this session. Will, can we get down to specifics about favoured product types and locations? Which markets do you see as ripe for growth in this sector? And what sort of product do you think is the most popular among investors? We've obviously seen the rise of the aparthotel over the last few years, perhaps at the expense of traditional, in inverted commas, service departments. What do you see happening over the next year or two?
I was going to say, if I knew the answer to that, I'd be sitting on my yacht in the Bahamas. But yes, it's pardon me, it's a very, very difficult market at the minute. No, I mean, you're absolutely right. If you look at companies like Seco and Eden, they start off, and Native as well, of course, all start off as service departments to try and expand quickly and expand at the right levels. It was impossible, not impossible, but it was very, very difficult for them to do so, and therefore went down the aparthotel route. So I do see the aparthotel model, very much the area of growth. As you know, Seco have taken some of their existing products, the service department part of the original portfolio, and converted those into Cove. So we are seeing the market become a bit more mature, and I think that's quite a good sign to see that actually you've got the lifestyle living products like Lock, which do an amazing product. You've got the environmentally friendly product that James Fry and Beyond are working on as well. And also Lamington Group as well. So we are seeing the market come out and come more evolved. I think the bit we haven't really seen yet is obviously beyond the urban, and I think that's the key part. But at the minute we are coming back to Louise's comments earlier. We are so undersupplied in terms of hard hotels and service departments. At the minute, there isn't the need to be too choosy, if that makes sense. There are some cities like Manchester, of course, where there is a lot of product. But again, Manchester KPIs are very strong. And I think one of the key things as well is about the branding. If you're in certain cities, if you're not branded, you are going to struggle just because of the amount of Airbnbs. Canary Wharf had that problem for years in terms of an uneducated market dumping stock, and therefore existing operators find it very, very difficult to yield manage, because yield management requires some intelligence in terms of that. And if you've got a rational stock coming on the market, then it becomes more challenging. So apologies, I've given you quite a politician's answer, but the key point is there's an undersupply. Branding is very important. The lifestyle sector is becoming, increasingly more important. I think people are fed up seeing glass tables, brown leather sofas. If I don't see another glass table for the rest of my life, that would be too soon. Let's try and be a bit more imaginative for how we fit these things out. And I think if you look at the product that Beyond have got, it's fantastic. Actually, it's really cool. And the same with Lock and various other operators.
The branding piece is quite interesting, actually, because this has been a traditionally fairly generic sector where branding wasn't all that important. It was about location and price. But you're saying that going forward, branding is essentially going to be essential to successful new entrants to the market.
But it's quite clever. If you get the branding right, if you think, we all thought about it, I do apologise, stupid expression. If you've got the branding right, I'm going to stay for, let's say, in a certain city for 2 nights, 3 nights. All of a sudden, I can now decide I'll stay in a 4-star hotel, or I can go and stay in an apart hotel. And if the branding is right, then you can start competing not just in the apart hotel world, you can compete in the hotel market. And all of a sudden, that means that yield in terms of your ADR, you're now competing at a much higher level. So it just means that whole yield dynamic becomes much more interesting. So, my viewpoint, that brand partner is great. You've got people like Residence Inn who, have got their American brand following is amazing, but yeah, actually the quality of the units are not really to everybody's cup of tea.
It's quite interesting that they brought that brand over here, because the product is very different from a Residence Inn in the US, obviously, especially in terms of space standards and so on.
The ADR they're able to achieve is amazing. If you look at the one they had in the former Think portfolio, if you look at that and look at how much better the ADR is today on that portfolio, it's one of the highest products I've seen going from being unbranded to branded. The uplift in ADR was substantial.
Yeah, I suspect we'll see more of the big hotel group extended stay brands coming to Europe. I think the ones that have come over, such as Residence Inn, Hyatt House, and Staybridge Suites, they've all done pretty well. I think we'll see more of them. Let's talk about these changing customer demographics then, because some of the brands you've mentioned, like Lock, Wild by Stay City, and so on, they've been very good at targeting the leisure customer as well as this kind of traditional business audience. But how do we think the two separate audiences are going to be affected by the current economic headwinds that we're seeing? And I'm not going to use the B word, but the mixing of business and leisure, is that the kind of is that going to be the saving grace of this sector? Is that what's going to keep towing it along? Andrew, how do you think changing customer behaviours are influencing investment and lending decisions in the extended stay sector?
Well, customer behaviour has always been changing, right? And actually, the evidence is, to be honest, that customer behaviour hasn't really changed all that much since 2019. Business meetings are back, as many of us always believed there would be. Conferences, exhibitions. What is happening is an acceleration, if you like, or certainly a continuation, arguably an acceleration of existing trends that were there before COVID. So the whole leisure phenomenon, et cetera, but that's a technology related driver, right? The fact is you can go to the beach in wherever you want to go to the beach and do work because of Wi-Fi and broadband speeds and all that sort of stuff. So So what I see, and incidentally, if you read the quarterly results of all the major companies, it's what they see as well, right? Is a continuation of trends that existed before COVID, and that flows through into the extended stay space, right? And what we're seeing is, for sure, what we're seeing is people coming to London and choosing to stay in an extended stay product because it's convenient, and you walk out the door and there's loads of places you can have something to eat if you want, or you can have it brought in, etc. I mean, I have a lot of, my wife is from New York, I go to New York a lot, my daughter lives in New York. I mean, frankly, you don't really need food and beverage in a hotel in Manhattan, not really, right? You can have it if you want, and the ones that are successful are the ones who have destination restaurants that people from outside the hotel come into. But there are a lot of hotels, I don't know whether they're apart hotels or extended, you can call it whatever you like, but there are a lot of hotels in New York which have basic means to cook a meal, right? Where there's no food and beverage, and they all do spectacularly well. And that is coming to the Europe, and it has been coming for forever. And as Will said, there's not enough stock really. But we're seeing different parts of the market. So you've got your luxury extended stay products if you want, and then there's all the way down to the more basic. So it's a continuation of existing trends. A lot of the trends have existed in the US for many, many years. Technology is supporting the pleasure concept, and I see that continuing into the future.
Thanks, Andrew. Louise, Andrew's quite bullish about the return of business travel. I'm not 100% convinced it's bounced back to the extent that he thinks. Are you seeing many proposals for traditional hotels that are aimed at the business market coming across, or is that not a strong model at the moment? Are people having to broaden their customer base?
I think everybody is aiming their products at both the leisure and the business market. So I think obviously conference hotels were very strongly hit in COVID. And is business travel back? I think everybody is seeing that business travel is back in some areas, not all, but in the areas it's back, it's more than made up for the areas that it's not. So for instance, longer term travel, definitely, we're seeing more of that, longer stays. The short, frequent trips, we were all worried they wouldn't come back, and to a large extent, potentially they haven't, but the longer trips have seemed to be making up for that at the current time. I have to say, from my personal perspective, as I'm traveling throughout Europe to look at the assets that we finance, what holds you back from traveling is the cost of the flights at the moment. That really has had a major impact on people's desire to travel frequently. You would, rather just accommodate that cost once and make more of your time when you're actually there. I think there's a lot of built up business travel that needed to be done because we hadn't been able to get out and see people for a very prolonged period of time. So whether we're seeing it back to the levels it was or whether we're seeing a bounce, probably we need to wait till next year to find out.
Yeah, okay.
Can I just say that I'm deeply honoured that you should attribute these views to me, but actually, if you read the quarterly results of the major international hotel companies, this is what, in fact, they are saying, right? So it's not just me, although I'm delighted to accept it. It's actually Tony Capuano, it's Chris Nassetta, it's all these guys, if you read what they're talking about.
Yeah, well, you're on the same level as them, Andrew. I place you in such exalted company.
You're one of my favourite people, thank you.
Andrew, you kind of get a peek down the road at what's likely to happen in the markets in terms of consolidation, M&A activity, asset deals and stuff. Do you think 2023 is going to be busy, and are there any major deals that you think might happen in the next 12 months?
Well, yes and yes. Now,
usually you say yes and no. That's good. I've never...
Yeah, well, you asked me two specific questions. Yes. So, but there's an element of complexity to this. It depends what your view is of the economy. If you think the world's going to be in deep recession for 3 years, then the answer would be no. I don't take that view. And many economists, sorry, I'm not an economist, but there are many economists and commentators who don't take that view. But it's a credible view. If you think interest rates are going up to 5-6%, then you've got to batten down the hatches, right? I don't take that view. The markets don't take that view. If that view, if it's a mild recession type scenario, which I believe it will be, then I think you'll see next year to be very strong as well, for all the reasons we discussed earlier. And there's another point relating to that, which also relates to some discussion earlier about development. I mean, actually what is happening, the problem with development finance is you show a development project to a lender or an equity partner, whatever, right? And they're thinking, well, what are the market conditions now? And how, you know, and they look at it from the perspective. Now, actually what's happening is supply chain, blockages in supply chains pretty much been resolved, right? The cost of logistics has pretty much fallen back to where it was before, right? You've got a freeing up in the labour market, so the issues associated with labour are pretty much over, right? You've got many of the airlines, to your point, Louise, about travel, many of the airlines are saying they'll be back to a normal schedule from early next year. So all I'm saying is the dynamics are pointing towards a normalization of the supply side of development pretty quickly, even if it hasn't already happened. But the problem is lenders, no disrespect to Louise, but lenders, investors look at things in terms of the past, right? And what they've seen in the past, and they'd rather wait till it's all settled before committing. And I'm not saying that's right or wrong, but actually, if you look beneath the surface, there are many trends which are very positive, and that will manifest itself in terms of transactions and financings and all that sort of stuff first half next year. That is my view. But Will, you also see a lot of stuff that's happening as well.
Yeah, well, I mean, you say that, but people are too scared to bring things to the market at the minute. I mean, we've got a number of clients who would like to sell various assets. And I was speaking to one recently who owns an airport hotel, a London airport hotel, just for contextualization. And, you know, we're discussing what was the best strategy. But, you know, if you try to put something on the market today and then try and say, look, actually, my client isn't in need of selling, he'd like to sell, but he doesn't need to sell, then people still think there's massive discounting out there. And, you know, my client is saying, well, look, actually, I don't need to sell, I would like to sell. And so why would I sell it at a massive discount? So that polarization in the market is just completely blocking it. And I think, Andrew, you're right. I mean, we think, you know, next year, I think there's a lot of stock that's sitting there ready to be taken to the market, and now it's too late because obviously you can't bring something to the market now. It's too close to Christmas. Well, you could do, but depending how complex it is. So it's just got to be interesting to see what happens. Remember this time last year, we had this frenzy in the market. You remember the market was going crazy. We're seeing yields coming in at crazy levels and so on. And then this year, you know, it's all very quiet. I mean, if I look at the amount of transactions going to happen in Q4 this year versus last year, it's a very different story.
Okay, interesting. Thanks, Will. Andrew, is this sector mature enough in Europe for consolidation to be taking place yet? I mean, can you see companies changing hands next year?
Oh, yeah. I mean, you know, companies have assets and operations. So, you know, a company is just a structure in which hospitality assets and operations exist, right? So for sure, there's no question about that. I would also expect some companies that are currently in the hands of private equity to come to the stock market. I think that is almost a given. You know, I think there'll be quite a lot of activity there as well. It's all part of the financing market, the M&A market, companies and assets and so on.
And do you think we might see any major new players enter the market next year? And if so, what sort of entities will they be? Will they be a Brookfield or an APG with, you know, with massive financial resources, or is there people of all sizes to get involved?
Yeah, look, I think you'll see some private equity companies who haven't historically played in the space wanting to play in the space because of the inflation resilience. Trade people amongst the sort of corporate universe who are not in the business, probably not, right? Probably not. But certainly you're going to see a lot of private equity companies who haven't played in the space getting involved. Of that, I have no doubt at all.
Okay, thanks, Andrew. So I'd like to ask you each in turn. It's a double question, and it's quite a big one, so we'll take a bit of time to address this one. What do you think are the main opportunities ahead for the extended stay sector, and what do you think are the biggest potential barriers to sector growth? Louise, can I kick off with you on that one?
Yes, I think the barriers, I think, is a lack of stock to buy to actually expand the sector. I think just straightforward purchases of hotel assets are very difficult to come by at the moment, let alone anything that needs more additional work to turn it into the serviced apartment. I do think, I can't think who touched on it earlier, whether it was Will or Andrew, but I think the branding is an important point, because I do think, look, some of the serviced apartments that we see are seen very much as being, if we look at hotel world, we're thinking about the boutique product becoming more and more predominant. People want something a little bit different, a little bit special. And I think there's a lack of that in the longer stay side of things. So I do think that would be an important growth area to pull in a new market.
Okay. Will, how about you?
Louise is taking all my lines as usual. Thanks, Louise. Look, I think from my side, I think the large hotel operators have been completely asleep at the wheel on this. I mean, this sector is going to grow. As I said earlier, I mean, there's very, very few businesses out there that deliver this level of profit conversion at a low risk model. You don't have 11 chefs walking out on you for a dispute, and so on. So, my viewpoint is the major brands from the hotel companies need to, well, they are looking at it, let's be honest. And I think that will be a big change on that. So I think we will start seeing more of that coming through. The question is, will some of these big hotel companies, we've saw also Accor have been going out buying lots of companies. Ironically, I don't think they bought many service department companies, which is quite interesting. Obviously, they've got their Diageo product themselves, and also that's expanding and growing in terms of that range as well. But the Staybridge product-wise, it's very nice and functional. Is very hard, and it's not something I'd want to stay at myself when you've got lots of other stuff. So I think there will be that lifestyle, more spread of different types of accommodation. And also the environmental point, I mean, Louise touched on there about people traveling for work and longer stays. And, for our ESG credentials and so on, I think that's another point as well. So I do think people are going to start looking at that aspect as well. And then in terms of challenges, it is supply. It is really crippling what people want to do. If you speak to Stay City, Lock, if you speak to lots of operators, they have a pipeline. So they have a committed pipeline, and they just can't get things to stack at the minute. So until debt, bill costs and so on all come down, then the minute that supply is completely sitting there, which is so frustrating, because we could get on with it. And Andrew rightly alludes to it that if this is your own money, you'd go, do you know what? I'll start building this now, because I know in 12 months or 18 months or 24 months, whatever it is, I'll have this up and built, and I can make this work. But it's just that short-term issues. And I think the contractors bit is still a major problem for the UK. I think I said this to you before, that one of our a hotel development in a very prime city, he can't get contractors. I mean, he's went out to 24 contractors. I mean, that's just absolutely crazy. So, maybe with this slowdown, that things will become a bit more realistic. And also fixed price contracts. I said somebody, people joke about it nowadays. So, what is a fixed price contract? They don't exist any longer. And again, people like Louise and other people need some sort of certainty in terms of build cost, because we're not going to write an open-ended check just to get something to develop. So, yeah, apologies for being a bit pessimistic. I mean, I do think it's so frustrating, because the sector's doing very, very well. There's lack of supply. The sector's starting to evolve. We're starting to see some really interesting new kit coming out. I mentioned about Beyond and what they're doing. And actually quite interesting to look at Beyond. They're also looking at taking existing residential models and converting those into service apartments. Do apologise. So there's lots of stuff that's happening out there, and it's all getting quite exciting from my side. But just supply.
Yeah. Well, with a wonderful stroke of synchronicity, we've had a question in from James Fry as you were speaking.
He's correcting me, is he?
I'll ask you this one now, Will, while we're still talking. James says a huge amount of money is going to ESG-based funds. would you anticipate lower exit yields for ESG-focused hospitality assets? And if so, how much?
The answer should be yes. But also the answer is, should William be thinner? And the answer should be yes as well. But unfortunately, we all know where that's ended up. Look, I did actually. I think actually, Louise, you were with me at the time. Actually, we were at an event, and I did speak to a pension fund manager, and we're having this debate. And I said, look, let's cut long story short. How much extra, or how much sharper yield would you pay? He said to me when I pushed him, and I appreciate this was after a few glasses of wine, and I was at an event, but when I pushed him quite hard on this, he said between 10 and 15 bips. The problem is, you try and quantify it, it is a nightmare. I mean, the only thing I would say to you is also we're valuing on if it's an operational trading entity, also we're valuing on a cash flow and on a DCF. So therefore, if the building is much more environmentally green and sustainable, then of course, the profit level should be enhanced, because obviously long-term wise it's there. So that will kick in for sure in terms of valuation. And then the question is, do you tweak the yield? And yes, if I've got two buildings next door to each other, one is, let's say, a first generation product, which is not very green, energy efficient, versus, let's say, one of James's products where, he's not using any chemicals in his paints and his furnitures and so on, and is very environmentally friendly, then there has to be a yield shift difference. But trying to quantify that is very difficult. And then people like Louise will say to me, "Will prove that to me," and then we have a very short conversation, and it's impossible to prove.
Yeah, Louise, what's your take on James's question?
Yeah, I think obviously we're seeing that value uplift in the office markets, but it's very different on the hotel side of things. It's been a different conversation. I think, as Will says, it's all about the underlying profit of the asset. And actually, whilst there are some cost savings in the cash flow from energy efficiency and so on, that top line is really where the problem is. The transient leisure guest is not spending more to stay at these wonderful energy efficient assets. So, and I don't see that changing. Now, definitely the corporates have an interest in hosting their events at assets that have very strong ESG credentials. But when such a large volume of your business is from this transient leisure guest, and they're just not there with that yet, then it's quite hard for that to turn into an increased value. I think probably what we will see is for hotels that have really been, or any asset class that's really been left to go into dilapidation without, the right investment, that obviously you're going to see very larger valuation falls on those assets, I would have thought. So potentially, as we're talking about the longevity of the asset quality, then it will become more important.
Yeah, okay, thanks, Louise. Andrew, do you just want to address James's question before we move on to your opportunities and potential barriers? We've gone off on a bit of an ESG diversion there, but I'd like to hear your take on James.
Yeah, look, I mean, I take sort of a slightly different approach to this. There's no question in the US, in certain parts of the US now, the corporates are insisting on that their people stay in hotels that tick various boxes when it comes to ESG. They are getting higher ADRs, lower yields, all that sort of stuff. That will eventually migrate around the world. But I do think the key driver of this, and James knows my views on this, the key driver of this will be bank capital requirements. That's the driver, right? And we'll already start to see, an article in the FT yesterday about the ECB starting to get a bit sort of aggressive in relation to bank capital requirements if banks haven't done all they can in order to reduce their own carbon footprint. There's various International Sustainability Standards Board are putting together a framework which will provide the basis for ratings and stuff like that when it comes to ESG. So all this stuff will happen. And the last piece of the jigsaw will be the PRA here, the Bank of England, the ECB, and all the various regulatory authorities saying, allocating more capital on bank balance sheets for lending to those assets that are below a certain rating. Well, that will drive yields, it will drive everything. So given that commercial banks are the biggest providers of capital in the world, I should imagine, as a class, right? That's going to be the main driver, and that will happen over the next few years. So,
Andrew, do you think, how many of those do you think will just be greenwashing, and actually how many of them actually? I mean, I've not mentioned which bank it was, but they asked me to look at something, and they were claiming this is for a green fund, part of their bank, and I looked at the credentials of what was actually happening on the ground. It's just greenwashing. There's nothing in there really material.
How it is, Will, and DWS, which is the asset management arm of Deutsche Bank, have actually been raided by the police in Germany because of leading investors. So that's what it is now, right? But we're looking at the future. Yeah. And that is my.
I'm quite skeptical of. I mean, it doesn't need to happen. Don't be wrong. I'm very pro it. And also, when we mention ESG, we should also mention the S word of ESG, which often gets forgotten about. And that S part is equally important as the E and G. And I think that's also something that, how do we monitor that, and how do we, quantify the S part of ESG, and also how do you quantify the E bit? It's a nightmare. And BREEAM, as we all know, doesn't really work for hotels, and it certainly doesn't work for apart hotels either. So, it's the whole system just needs a complete overhaul.
That's a whole other webinar. But Andrew, can I just quickly get your take on the opportunities and challenges ahead for the sector before we wrap up?
Look, I mean, I think there's a lot of really interesting, fairly small brands out there. Stay City, which is big for a private company, but small in the context of the big brands. And you've got Residence, and you've got Super City in the UK. You've got Eric Vocal. You've got really, really, really good smaller brands who have a small-ish footprint. I mean, these are going to expand a lot in the next few years, of that I have no doubt. And that is very interesting. Amongst the obstacles, one that, well, I'm surprised you didn't mention this, given who you are, but planning is just a nightmare, right? I mean, there's real confusion here. C1 in the UK. C1, C3, is it a service department? If it's C3, will they enforce the C3 requirements, all that sort of stuff? You've got the Airbnb rules about no stays of less than 90 days for more than 90 days, I think it is, whatever it is. Some councils enforce, some councils. All this stuff provides more uncertainty, which is not what lenders like Louise and equity people and any forms of any provider of finance wants. And that's a big obstacle. I mean, there's a big obstacle in the economy generally for all planning and stuff, but specifically in this area, there's real confusion, right?
Yeah, absolutely right, Andrew. I was speaking to one of our planning colleagues, and to me, it's vanilla. I mean, it's quite clear that apart hotels and service departments are hotel use under planning law, okay? But, they were challenging me and saying, well, actually, we were looking at something in Westminster, and they were going, well, actually, well, it's not, as you're right to say, Andrew, it's not black and white, and yet it should be. And I get that the system's been abused in the past, where people have tried to, get apart hotels through or certainly service apartments wasn't actually apart hotels, to avoid affordable housing and so on. But we all know there's lots of service apartments in the UK which have got residential use and have been operating for years as service apartments, and nothing's been done about it. And after X number of years, they'll be able to claim that. But you're right, Andrew, there is a real challenge, and I think. George, actually, that's probably another seminar, as you rightly say, for your list.
It's all giving me ideas for next year.
It is becoming very, very challenging, and it shouldn't be, in my viewpoint. I just think some of the local authorities really don't understand the sector.
Yeah, you agree again, Will?
I'm getting concerned.
We'll leave it on that lovely note of accord. Incidentally, thanks to Brian Okniansky, who has written in the chat that BREEAM is developing a BREEAM in use specifically for hospitality. So more of that later. But thanks, Andrew, Will, Louise. That was a really, really interesting session. I enjoyed that. Just going to show a couple of quick slides before we finish. So the next Service Department News webinar is a week today, November the 11th. And my colleague Felicity, the assistant editor of Service Department News, is going to be chairing that one. And it's that'll be a deeper dive into business travel and how that is faring. If you'd like to join that one, there is a link to register in the chat. Just quickly wanted to point out an event that we run every year in January called Recharge. It moves around various European cities, and next year's is in Lisbon, which I'm very much looking forward to. You can see some of our sponsors for that event, and you should be able to see a link in the chat to buy your tickets there. I thoroughly recommend coming. I think it's the favourite event of ours that we do. It's really good fun. And finally, next week we have a webinar about the build to rent sector. It was due to be an in-person event, but every time we moved the date, so did the industrial action of the various train workers. So it's next Thursday at 9:30 for an hour and a half. There are going to be 3 half-hour discussions about key topics pertinent to build to rent. One of them is the suburban and single family market. One is ESG and sustainability. And the other is build to rent's role in addressing the housing crisis. And you can see the link to register for that in the chat. If you're interested with working with us at IHM, maybe sponsoring some of our webinars, our live events, then please get in contact with my colleague Katie, whose details are on the screen and also in the chat. We're going to leave the countdown clock running for a couple of minutes again when we finish this session, just so you can take some notes of all the info that's in the chat. And that just leaves me to say thanks for joining us. Thanks ever so much to Andrew, to Louise and to Will for their contributions. I think it was a fascinating session. Thank you for watching. See you on the next webinar and enjoy the rest of your day. Thanks very much, everyone.